You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The Options Insider Radio Network is sponsored by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. The Advisor's Option is also brought to you by Northern Trust Capital Markets, offering a unique blend of transparent trading, quality execution, and smart liquidity solutions across institutional brokerage, transition management, securities lending, and foreign exchange. Northern Trust's options offering includes quiet access to non-traditional pockets of liquidity with hands-on support from experienced traders to customize your trading strategy, combined with the peace of mind that comes with trading through a stable and globally respected firm. To learn more, contact John Cherry at John_Cherry, spelled like the fruit, at ntrs.com. or visit northerntrust.com/capital markets. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it's time once again for the Advisor's Option, the program for you, the busy financial advisor or asset manager who maybe you trade a little bit of options already for your clients. Maybe you're thinking about dipping your toes into those options waters. Either way, we've got you covered with some education, some breaking news from the world of options, some timely stuff like we'll get to on today's show, and as always, answering a whole bunch of your questions. And joining me to help me do just that, we have our usual stable of cohorts plus one. Starting off, let's go in order of north to south in a circle clockwise, and then back here to Chicagoland. So let's start all the way up there in the hinterlands, not quite of Maine. We're going one state over to New Hampshire, where we are joined by our old friend, Mr. Matt Ambertson, the principal over there at ORATS, a.k.a. Options Research and Technology Services. Matt, welcome back to the show, sir.
Great to be here on a spooky day. Thanks, Mark.
Not so spooky in the markets today. It has been spookier of late. We'll certainly get to all that in a little bit. Not a ton of red on the old screen today, but I guess if you're a beer, it's even more spooky for you out there today. Also joining us, following that clockwise hand down into the ocean, actually, out there into the Atlantic, all the way out to Puerto Rico, where we are joined by Chris Hausman, the portfolio manager and managing director of risk. I need a director of risk in my life, but he's a director of risk over there at Swan Global Investments. Chris, welcome back to the show. And what do you say? Are you for hire? Do you do general life risk as well? Can you say don't cross the street, don't jaywalk?
You know what? If you define the risk, I'll figure something out for you. How's that? But it's good to be back on. It feels like it's been a while.
It has been. A lot's been happening, probably. That's why, since the last time we all gathered here together, which is probably why it seems like it has been so long. And also joining us, taking up a new co-host seat here on the show, I am pleased to welcome. He's been on the show before, but not as a co-host. He is John Cherry, the global head of options over there at Northern Trust Capital Markets. John, welcome to the Advisor's Option.
Thank you, Mark, and good to be here. I feel like I finally made it, joining the wonderful panel.
You made the big time. You're official now. You have our seal of approval here. Before we get going on to the show, really quickly, John, I know you've been on before, so some of our listeners may have heard that, but really quickly for our listeners who may have missed your previous appearance, give us a little bit of an overview of your background in the option space and what it is you do over there at Northern Trust day to day.
Sure. Yep. So global head of options here at Northern Trust. I've been in the business since the late 90s. Starting my career at Rothschild Investment Corp, trading equities, and started my options career in 2006 at Man Financial, and really never looked back, servicing the institutional community, trading options on behalf of asset owners and asset managers.
There you go. And he's going to help us deal with all this craziness that's going on right now. So without further ado, let's get right to it. It is time for the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, welcome to The Buzz. This is the portion of the show we break down latest developments in the world of options and derivatives that you may not be aware of. This time I'm going to go out on a limb and say you're probably aware of what we're going to talk about, because we are recording this right now, right at the end on Halloween, on the end of October here, October 31st, obviously. And oh, what a month and change it has been since the last time we have gathered together. Volatility has come roaring back to life, not the least of which thanks to a lot of substantial shocks out there to the marketplace. We've seen multi-percent sell-offs over here in the broad equity market since the last time we've gathered gathered together. And we've seen also commensurate multi-percentage point moves to the upside. So it's been a lot of volatility back and forth. We're currently, as we record this, in the midst of the ladder, a very aggressive swing to the upside. Most of the major indices are up 1% or more. S&P up about nearly 2%. Dow up 1.5%. The tech-heavy NASDAQ up nearly 3% on the heels of some good earnings out there in the tech land. Volatility is taking a little bit of a break, as you might imagine, today, at least in terms of, that downside bias. At the end of the day, movement is still movement, so it's still going to accrete to some volatility. A 2% move in the S&P is still a big move, but we are seeing volatility coming off out there as measured in our old friend, the old fair gauge, aka the VIX cash. It hit a high of nearly 29 since the last time we recorded, 28.84, and it's kind of been vacillating around in the high 20s for most of the time ever since. Even earlier this week, it got up to almost 28 again, so we have seen some nice shocks. But of course, this sustained upside for the past few sessions has put at least calming it down, certainly making my volatility views crystal ball prediction for later this week of, I think I was about 18.15, 18 and a quarter. Looking a lot better than it was a few days ago. Only about 3 handles away from that right now. We're right around 21 and a quarter or so. So, John, since you're new to the show, I think we'll start with you. These are obviously tumultuous times. I'm sure your phone is ringing off the hook. That's one of the reasons why you couldn't join me here in the studio today. You had a lot of client business to deal with. So, first off, walk us through what has the last month been like for you over there on the manning the options desk over there at Northern Trust. What are you hearing from your clients? And also, what are your thoughts on this current volatility regime out here? You think this is sustainable, or are we kind of just blipping? What's your views on what's going on out here?
Sure, great question. So, to kind of recap it's great timing. Kind of recapping the last 30 days or so, it's been interesting. Several inbound and outbound calls with clients centered around, should we be thinking about repositioning? Is this a short blip on the radar as far as things are concerned with the broader markets here in the U.S. or even looking at the international markets? Our kind of stance as far as how we engage with clients at the capital markets level is it's kind of somewhat business as usual. When you have periods of this where there is somewhat outsized volatility or sharp shocks to volatility, we believe it more creates opportunity. When you're looking at options, for a retail investor or even an institutional asset manager investor, there are certainly solutions out there that help you either enhance or hedge a standpoint in a view that you have within your overall portfolio. So we look at it as you kind of take off the traditional trader hat and you put on your consultative advice hat and have these conversations with clients.
Yeah, there's a lot of hand-holding that goes on in periods like this, as I might imagine. You're as much psychologist as you are, trading an advocate and risk manager out there as well. They're trying to talk people off the ledge. But that's kind of what we were talking about earlier. That's kind of where some of the benefit of having some experience in the marketplace and the options world for a while can come in to help. Because, we've all seen a few shocks like this now. It isn't exactly super scary. It still is certainly worthy of note, but it also gives you some perspective to say when, things like VIX is crashing up or spiking up to 30, maybe you can talk people off the ledge, John, so they're not going to dump their whole portfolio in a panic or not racing out to load up on a bunch of vol at those levels.
That's exactly right. And looking at VIX in particular, these are levels that, I assume many of the listeners have an understanding about. If you look back, at least a decade or so, outside of a few handful of events, these are not levels that really anybody has seen. But your more seasoned type investor or people that are experts within the business have seen these levels before. And so, really, anything in the mid-20s range is level, kind of a sweet spot level for an options trader.
Yeah, that's certainly a nice spot where you get a little bit of life, but it's not too crazy. It's not what I often refer to be the take your ball and go home level of VIX, which varies by person, but is usually a wee bit north of there. Chris, as the newly minted director of risk over there, this is a auspicious time to have such a title because there is some risk in the markets. These are obviously also, I'm sure, interesting times for you guys at Swan because this is what you guys live for. This is what you guys are out there for. You're always talking about being fully invested, fully hedged. So for times like this, you can have a hedge and then put that to work for you. So these have obviously been interesting times for you guys over there. Walk us through what you've been seeing for the past month or so, and what are some of your thoughts on the current volatility regime, sir?
Well, it's always reminding a client, what are you in the marketplace for? here for a full market cycle. It's extremely difficult to time the market. So having products that are going to hedge you during larger events and not necessarily short-term corrections, is going to keep you invested and keep that return distribution that you're aiming for over a 5, 10, 20-year horizon. So, in today's world where everyone can throw out an opinion instantly, and one day things are good and one day things are bad, you just got to, you have to have a product or have a product out there for people where they're going to stay the course and not have to worry about that. Monday, people were thinking we're going to break 2,600 in the SPX and test February lows, and then all of a sudden now we've got 2 of the best days of the year rally, and people are feeling better. Did we all of a sudden have a bottom? I don't know. Again, it goes back to where market timing is very difficult. So it's kind of just remind people, what are you here for? What kind of product are you invested in? Is this going to build wealth over a longer time horizon and not necessarily a 1 week, 2 week, or a 1 month horizon?
And look, just curious, I like to get people's anecdotal, insights into this. What kind of calls have you been fielding? Has it been similar to John? Has it been, oh my goodness, I got to get the heck out of Dodge, this is terrible? Or has it been more kind of just general inquiries? What kind of stuff has been coming your way over the past month, Chris?
No, it's more general inquiries. It's not so much, again, they just kind of ask, where are we hedged? Where are basic levels? What do you think the market's going to do? And then we have to just kind of, talk people through that. Like you said, we're always invested, always hedged, but we don't necessarily provide instant correction protection, right? So we're not going to hedge out the first 5 to 10%. I mean, I've always kind of told people, look, if you can't handle a 5% drawdown, don't be in the equity market. Go somewhere else. So a normal 5 to 10% correction, even in a bull market, is just ebbing and flowing. The speed of that 5 to 10% correction, I think, is what's getting people off guard more and more, because it seems like it's getting quicker and quicker and quicker. So the question that we have to ask ourselves, well, we know that market timing is difficult, but we also have to ask a larger question. Have markets changed around us? Are the algos starting to take over? I remember once upon a time, and you guys can confirm this, it was most of the NYSE volume came from the SIBO market maker. That's completely changed now. And you've got 70% of the NYSE volume being driven by algorithmic trading. And this whole theme that we've been having, last year the theme was super low volatility with lack of liquidity. And it seems like the lack of liquidity theme is starting to grow. And so, yeah, I think markets have changed, and it's very important to, whatever product that you are invested in, understand it. What are the weaknesses? What are the strengths? What is it really going to hedge out? And when is that hedge going to kick in? So it's been pretty much standard questions every time you get a large downdraft like this in a short period of time.
Matt, same question for you. Obviously, you're fielding a wide variety of clients over there, from the institutional clients and the advisors to even a lot of maybe some high-end retail over there as well. What are some of the inquiries you're getting over there these days? And also, what are your thoughts on this perhaps return of volatility or maybe short-lived blip? What are your thoughts there as well?
Yeah, I would echo what Chris is saying. It does feel different. It feels like the algos are a little bit more in charge, and the market corrects and goes to a level faster, it feels like, than when we were traders on the floor. So I think you have to have your numbers and you have to have your levels predetermined. And that's what we're working on with our clients here, is having more systematic technical indicators. When are you going to cover? Risk on, risk off definitions. What are we looking at to help us navigate these waters? Chris said it's very difficult to time these things, but you want to have your indicators and you want to have already studied them. For example, we're looking at a short-term contango that's very helpful to us in looking at markets. How is the front few months relative to each other? How are those months behaving in implied volatility terms? What's the slope of that relationship? And we look at that, in February when the market went down, and then what happened? When was the blow off? When did you get a risk on and risk off? So, we got a small risk off signal on October 4th. So that was great for some of our clients. And now we're still waiting. We still think the contango is pretty steep. It did look like a blow off on the 29th. That was about as steep as we've seen in a long time. We like to see that. And then we'd like to see it come down more, but it's still up there. The implied volatility percentile hit 100% for the year. So that's usually a good blow off signal. We're looking at that. We're looking at the IV versus H fee, and how that has been as a percentile of itself, and that has gotten pretty high. So it's feeling like we got the blow off, but it's not. I'm not ready to jump back in on a risk on yet. The contango is still too great. So these are the things that we're thinking about. We're thinking about what are the numbers that have helped us before. What are the technical indicator numbers that are related to volatility that are going to help us not only get out of the market but get back in at the right point? We're not going to pick the bottom. We didn't pick the top, but we're going to get out and vary the income producing versus the long gamma, and put way out of the money puts. And that how that weighting goes. So that's what we've been talking to clients about. That's what we're working at, especially the more active clients. I mean, the other clients they just have the tail on and they pay for the tail and they're fine with whatever happens. Like Chris said, the 5% corrections, you have to be in for that if you're going to be in the equity markets. But the bigger corrections is what you really have to analyze the risk for and look at your slides with what happens to the entire skew. So that's what we've been fielding, Mark.
Yeah, you're right. That those 5% corrections, given our current velocity of the markets, that could happen in about 2 days. So, yeah, you're right. If you can't handle that these days, then perhaps you should look elsewhere. Really quickly, Matt, too, these are also, even without the volatility, this would be a busy time for you guys at ORATS because you guys are the keepers of the earnings volatility data. So we have broad market volatility. We have now earnings volatility, mixing it up as well. You guys continue to put out those great options move and option move results reports. So if all of you out there who reach out to us all the time and say, hey, I'd love some data on how earnings perform from a volatility perspective, Matt and his team have been cranking it out for you. You can find it over there at ORATS or, of course, at theoptionsinsider.com. Matt, you've been crunching the data on, I don't know, hundreds, maybe thousands of tickers at this point. Any interesting nuggets, any interesting takeaways, any interesting surprises for you so far? We're still kind of early in the cycle here, but anything really jumping off your radar that you think is surprising or maybe additive or reducing the overall volatility out there right now as a result?
Well, I appreciate that, Mark. And again, thanks for pushing me to really get that going. And I was listening to, was it the Option Block with Mark Sebastian? And
yeah, we talk about him all the time.
Yeah, and so I was going, oh yeah, so you were bringing things to my attention. But I mean, the big thing about this earnings cycle is, the level of volatility that we're seeing. So as you were mentioning on the Option Block. I think it was Microsoft. And I'll just I don't remember the numbers exactly, but the number for the amount of the move this earnings was 20% higher than its moves that it's had over the past 12 quarters. So, and and the stocks have been hitting those numbers. So, I guess the point with this earnings season is that just the general market levels are much higher, and that's leading to earnings market volatility that's much higher. But the results that we're seeing they're hitting those numbers. As you mentioned, the predictions of the straddles, and as you know, ORATS has a way to really identify the portion of the straddle that's applied to the earnings announcement or the day after the earnings announcement. We think a very good way to isolate that and then record that and how it reflected versus what actually happened. And we're actually finding that, to me it would seem intuitive that stocks move a certain amount on earnings, and it doesn't really matter about the general volatility of the market. But that's actually not so. The general volatility of the market is actually making it more volatile. So we're seeing good earnings last night, and the market's skyrocketing today. 3% up is a skyrocket for this market. So, and we're those numbers are reflected in the expectation. So, yeah, I mean, I think it's a doubly exciting time for ORATS. We have the earnings, and we have the volatilities, and we're seeing the confluence of them right now, Mark.
there certainly is a lot to dive into. We could probably spend the whole show on that, but we have to keep rolling. By the way, if you want to check out those reports for yourself, listeners, theoptionsinsider.com is, of course, the place to go. Click on ORATS or search for ORATS in our search bar. They'll all come up. Or just head on over to ORATS.com and click on the blog or some of the other areas there, and you could find a lot of those write-ups there as well. Our next story here in the buzz, before we get to a bunch of your questions, also suggested by you, Matt, as well as our friend Gunjan over there at Wall Street Journal. I think you two were both kind of chatting back and forth about this story. You both kind of suggested it as a good topic here for the show this episode. So let's get into it. It's a little deep in the weeds, but it has some impact on what we're talking about right now, which is volatility. This is, of course, the Financial Services Committee unanimously passing what they term the Options Market Stability Act. Now, stay with me. I can hear your eyes glazing over whenever we mention deep in the minutia regulatory things. But what's interesting here is this was passed, of course, by Illinois Rep. Randy Hultgren, because go figure, a lot of firms in Illinois want this to happen. He put in his release here, Illinois, the birthplace and the home of listed options markets. Healthy options markets provide ample opportunity for investors, go on and so forth. They go on to say here, unfortunately, market makers who provide liquidity for listed options are indirectly constrained by bank capital rules from fulfilling their role in maintaining price stability, leading to less liquidity and higher costs for investors who want to hedge risk. I won't talk about the whole thing, but this bill has now passed committee effectively. So it's not law yet, obviously, but it is on the way to being voted on in the full House and hopefully eventually Senate, and then hopefully getting passed. And this is, if you've been around the space for a while, this is a common refrain. We talk about this a lot in our shows here of just the strain that liquidity providers, the few firms that are left out there actually backstopping these markets that you guys like to trade every day, out there making markets and all these names and options you want to trade. It's become more onerous for them of late, just due to these rules out there that don't really take into account a lot of very simple things like netting out risk, or they mention here also delta weighting some of the risk, taking it into account an option that's a 1 delta versus a 99-100 delta type option. If you have offsetting positions, taking into account that. You hear these ridiculous stories from market makers now who say they won't even quote things like simple boxes just because the capital requirements make it too onerous. It's not profitable to even quote what is effectively a simple interest rate trade. So a lot of things like that are just negative. And why are we talking about it here? I'll let Matt get into a little bit more because it is his suggestion. But in a nutshell, this kind of thing, markets like this, we all need liquidity. And hopefully if we can ease some of the burden on some of these firms out here who are actually backstopping this liquidity, it can help all of us get larger trades done, get more liquidity out there, maybe damp down some of these systemic shocks that we're seeing out there in the marketplace. And in general, probably a good thing for all. Matt, this is your story. I won't put words in your mouth. Why was this one really resonating with you this episode? Why'd you want to talk about it?
Yeah, I mean, this is exciting to me, Mark, because, as an old market maker, we stood up to markets and we made deep in a lot of liquidity on the markets. And so what I've been seeing in the numbers, especially when it gets volatile in the market, that this liquidity is leaving the market. And I did I helped Gunjan with a story about the February debacle and what happened to markets, and it was it was terrible, really, what happened. The market, and it's hard to blame the market makers, and I don't blame the market makers because there are so few of them, and they don't get the support that we used to at least work with the exchanges. Now, with the exchanges being public, largely companies, that you don't have the camaraderie, or you don't have the support. The exchanges are doing their own thing, but it's starting to feel, what I really like about this is it's starting to feel like the power is coming back to the individual investors and to the market makers. We saw there was some commentary from the SEC about exchange fees and coming down, and the exchanges not being able to raise their prices as much as they do and support those raises. And now with this, it just seems like we need a stronger market making crew out there to really make the markets that we trade on and that we, at least at ORATS, that we're analyzing every day. We could see the liquidity going out of it. So this has been really important, I think, just signaling as much as what's in the law itself, that that the power is coming back to investors, and the power is coming back to market makers a little bit, Mark.
Yeah, this is kind of one of the dark sides, the unintended consequences of more regulation coming out of things like the market meltdown from a decade ago. Everyone wanted to crack down on these unruly markets, including what they term derivatives out there. And as a result, we saw a lot of changes in things like the Volcker Rule, which were all well-intentioned, but we've seen a lot of unintentioned side effects as a result, including, I think, as we referred to earlier, the volatility of volatility is much higher now. Things can gap around a lot more because there's just fewer firms out there backstopping this stuff, and these types of onerous rules are one of the reasons for that. Chris, you've been around the space for a while. Obviously, you're out there day to day looking to try to get size done out there in the marketplace as well. What are your thoughts here on this? Obviously, it's not passed yet, but it's taking the first steps to effectively becoming law, sir.
Yeah, I think more liquidity is a good thing. We definitely need that. My only thought is really, is this going to be enough to entice new liquidity providers / market makers to enter the market, or even entice ones that shut down over the last few years to re-enter? So, I'm hoping it is. I'm hoping that it does expand the liquidity market, but time will tell. Or have we just gotten used to trading, having 80% of all our liquidity in just a handful of products? Because, I would love to see a lot of these equities start picking up back again like they used to trade. But unfortunately, everyone's stuck in the indices and just a handful of equity products. So, I hope this is a step in the right direction, and I hope it does lead, to new entrants. And I guess we'll see if some old entrants kind of open up or turn on the lights again, then that's going to be a good tell.
Yeah, you're right. We always talk about that at things like the OIC conference. Oh, how do we get from, it's sub 20 names doing half of the volume out there? Something like this could potentially help with that. John, same question for you. Obviously, you're out there looking for liquidity for a lot of your Northern Trust clients, and also engaging with a lot of trading firms out there. So I'm sure you've heard a lot about the complaints that we have as well about these capital rules. What are your thoughts on this legislation maybe taking its first pivotal steps towards becoming law?
Yeah, that's right. I agree with everyone on the call today. This is something that our desk lives every day. We're an agent, broker, dealer, and so sourcing liquidity for clients in any type of market, in any type of option product, index, ETF, or single stock option is a core competency of the desk. However, I can tell you that anytime markets get I'll use this in air quotes, slightly out of whack, it seems to be that liquidity kind of just runs scared. And so, it makes our jobs a lot more difficult and challenging, whether you're trading a simple option strategy or a complex option strategy. So anything that, any legislation that can come through that entices more market participants to enter that market, as Chris said, whether that they were once here and no longer, that may re-enter, or loosen the constraints at the bank capital level, I think is a welcome sign. When you're trading these instruments, sourcing from unsolicited client orders into market makers, they really are they're positioning their books accordingly. They're fitting trades that can benefit just the marketplace in general, not just giving edge from one investor to another.
And next up, we turn now to the Swan blog. They have all good stuff over there as well with your research team there, Chris, of Mika, and of course Mark. I think this is Mark's paper here talking about, and this is a topic we talk about a lot. I'm sure you guys deal with this a lot, obviously, over there at Swanland, because you're talking about having a hedged investment. People always probably come back to you, or they come back to us when they want to push back against using options. Well, I'll just do the standard diversification protocol of 60% equities and 40% bonds, and then I'm diversified. I've done my diligence for my clients and indeed for myself. And Mark did some number crunching over there, which is kind of interesting to see how that traditional 60-40 allocation portfolio actually works out. And, talking about looking at that data over different time periods and having a few periods where it did all right, like back in, March 2007 or to about March 2009, when things were going crazy, the bond portfolio kicked in. But since then, of course, we're in a different regime now, a different era. We've seen kind of the loose policies of the Fed probably coming to an end. So the bonds probably not going to be that kick-in engine that maybe they used to be in those early periods. So not exactly going to be a big driver for capital appreciation going forward, or even that sort of hedge you need in these types of downside environments. Chris, I won't put words in your mouth. This is obviously your research coming out of Swan here, but this is interesting stuff. This is a question all of us here on the show get on a regular basis. Why shouldn't I just do this standard diversification thing? Why should I bother buying a put? Any thoughts here on this research, Chris, and maybe your takeaways from it?
Yeah, I mean, bottom line, rising rates are going to hurt capital preservation when you're talking bonds right now. So, assuming the Fed continues on this path of tightening under what currently we still think are healthy market conditions, that's going to impact bond prices negatively. So, if bondholders, they're going to start feeling some pain as rates increase back to their historic average levels. And, this may be good for those who want income, but it's going to be a problem for those who are seeking capital preservation. And the good thing is that people have options now, right? No pun intended. There are other ways to truly diversify portfolios. And I think one of the best things is using options in a portfolio to hedge out that kind of risk. Because as we all know, when that bear market does come, we're going to see correlations go quickly to 1. And we already see them. We've already saw correlations take a huge jump this month. And so if a real bear market does come, well, you know what? Bonds is not going to be a place for protection during a bear market. So there are other ways to hedge. There's a lot of other money managers out there that are looking to the option space. And, that is something that we do, like you mentioned earlier, always being invested and always hedged.
And I know you guys always send us a lot of questions. I want to get to a bunch of them. So without further ado, let's dive into an extended edition of our Office Hours segment.
It's time to answer your pressing questions about options. It's time to start our Office Hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the Office Hours. The shingle is up. Your questions are welcome, and oh boy, do we get a ton of them. All over the place. We also like to ask you guys some questions too. I want to make the panel weigh in on this because I don't want to take too much time on it, but just kind of curious to get your pulse right now. We are in this volatile regime yet again, even though vol coming in a little bit today and yesterday. We asked you guys, vol all over the place these days. Some say it's too cheap, others too expensive. That's what makes the market, right? So you guys like to trade it. We know that. What's your weapon of choice? We gave you 4 choices out there in the VIX complex. So directly trading VIX options or futures, maybe a more indirect approach like an ETP, like VXX, the options or the underlying there, or even our old friend TVIX, one of the last of the Mohegans of the inverse space, or even the more direct approach, which is just the SPX options, or even some SPY for you out there. And so far right now, with a couple days left, 50% going the direct route of the SPX or SPY options, trading your vol directly, not going through the arbitrary calculations, at least seemingly arbitrary sometimes, of the VIX land, going straight to the implied vol of the S&P, which is interesting. Again, speaks to kind of the nature of our sophisticated audience out there. 25% saying you like yourself some VIX, 18% saying VXX, only 7% for TVIX, which is kind of what I figured. I'm not a huge TVIX guy myself. You got to listen for a while, you know. I'm not a TVIX man. I remember when TVIX melted down the last time. It had nothing to do with anything in the marketplace, but that's a conversation for another day. All right, let's get to some more questions here. First up, we got it from Andrew. Andrew S., he's a CFA. He says, I know that in most trading accounts, brokers will allow you to write puts with somewhere between 20 to 50% margin kept in reserve. But am I correct in assuming that you cannot do this in IRA accounts, only cash secured puts? That dramatically increases the capital cost associated with this strategy. Since most of my clients are in IRAs, I don't think I will be pursuing this for them. Do you think this limits the utility for RIAs, since I'd imagine the large number of advisors fall into this category? Interesting question. We touched on IRAs a lot here on the show, just because I know it's alphabet soup, IRAs, RIAs, a lot of it. But it's all applicable here. But yeah, this is an interesting topic. John, I know you love yourself some questions, so I'll give you pride of place on this one. What do you have to say for our friend here, Andrew S., who's concerned about using leverage in an IRA, being able to write non-cash secured puts in an IRA? Can he do it? And he also, what are your thoughts on if this maybe will mitigate or does mitigate some of the utility for options for a lot of advisors out there?
Sure. Yes, it's trading, selling puts that are kind of using that leverage effect. So only 20 to 50% kept in reserve is within an IRA environment, or even just in general, is somewhat an anomaly post financial crisis today. I mean, a lot of our clients that are writing cash secured puts are doing it on a fully funded basis, so fully collateralized, whether that's via cash and or T-bills. And so to then add that element of an IRA is somewhat unusual from a Northern Trust standpoint. So do I think that it limits the utility for an RIA to use short puts within the strategy for IRA accounts? To an extent, yes, if you wanted to do it on that, using that leverage effect. But again, the most common thing that we see here within Northern is that irrespective of an IRA or not, it is being done on a fully collateralized basis.
This would be a good time to have our buddy Eric from OIC on. Unfortunately, he couldn't make the show. He's traveling. He was actually in studio a week or so ago for FIA. So if you want, they have some great data on this stuff over there, listeners. So I encourage you to check out our interview show, our Options Insider Radio interview show, or my interview with Eric is up there now. So in lieu of coming on the show today, he did a little interview hit with me, touched on some great data. Check it out. Just get on over to optionseducation.org/advisors. They have great data on this type of stuff as well. What RIAs actually use options for, and I think some of your question there will be touched on. Chris, same question for you. You guys are out there with your 10th box events out there doing a lot of interesting stuff and just educating advisors. You get this question, I'm sure, a lot. What are your thoughts on cash secured puts and their utility in IRAs for advisors?
I mean, there's always a use for them, but, I agree with John. They can be capital intensive. They are capital intensive. So the only thing I really wanted to add is that, maybe RIA should also look at put spreads, shorting put spreads, and maybe that'll offer them a little more flexibility in being tactical with market movements and not be so capital intensive.
Yeah, people always forget. They think of selling puts as, it's just this free money. I'm going to pick up this, 58 cents that's sitting here on this bid by hitting it, and now I have that 58 cents, and it's mine to use or whatever I want to. They forget about the capital component, the margin requirement that's put aside there. Your broker's not just going to let you have that money for free. You have to hold on to it. You have to keep money in reserve. So you always have to consider that when you're looking at these strategies. And we advocate these strategies are good, and they're very useful for a large number of people out there, but you have to make sure you understand all the costs commensurate with doing them. Let's see here. Mr. Bode, I'm just going to go in order and let you guys have any that really scream out at you on the list. We got so many to get to here. Mr. Bodine, he wants to know, general question, what are the three main option strategies used by advisors? Well, I'm going to go out on a limb and look at all the data I've seen out here and been doing this show for a number of years now and listening to what you guys want to know and talking to a bunch of advisors as well. I'm going to go out on a limb and say it's the covered call for income. The other side of that could be, it's kind of a flip for the other point. I'm going to say covered call for income, protective put for hedging, and then I'm going to use the holy grail that mixes them together, which is the collar, which so many advisors love. They get the income and they get the hedging protection. But, that other one you mentioned, there might be a good fourth, which is the cash secured put. People like to do that as well. Again, more cash intensive, more margin intensive in an IRA than elsewhere. So that's why I put it number 4. I'm curious, I'll toss this out to anybody, whoever wants at it. If anyone wants to challenge my top 3, maybe you have your own, or maybe you agree with me, you think I'm a genius, let me know. I'll hear that as well.
It's Chris. I guess I'll go first. So this is interesting because I just recently broke down every single fund that was in the Morningstar option-based category, just old school, tee it up, position breakdown via synthetics. And what we did is we kind of put, we got 3 major categories, which you've already kind of discussed, right? There's the hedgers, the income producers, and then the ones that really didn't fall into those 2 categories, we just put in alpha trading. So yeah, you saw protective puts, collars, and put spreads in the hedging, for the hedgers. Covered call was definitely the largest. You had some short strangles in there and short straddles. And then the alpha trading strategies were a bunch of different ones where they were trading calendars. You had some variations of iron flies and iron butterflies and things like that. So, but as far as what you said, I don't disagree. But, my take on breaking all of them down was that, a lot of the strategies were pretty straightforward. There wasn't anything that was too crazy in there. And again, all of them trying to achieve some type of objective.
Yeah. And Mark, this is Matt. What I'm seeing, in the back testing, and it might be skewed a little bit because the back test, I think, really helps your intuition on some of these more complicated strategies. But we tend to see more of the complicated strategies things like selling a straddle and buying the wings and iron butterfly, or just selling strangles out there. We're seeing a lot of testing in that now. Again, that could be skewed just because the back test, they want to see how that performs over time. But my favorite strategies are yours. I like to see a protected put. I always like to see that in someone's account. I like to see some income producing. I actually like selling call spreads, because what you're seeing a lot in the market is a lot of the appreciation of stocks happen in a very quick spurt. So you don't want to lose all of your upside. And then I like to see some type of a collared strategy as well. But you could also have some income if you have that kind of out of the money put. You could have a short put spread. So those are what I test the most, and those are what we're seeing the most, are some of those more complex strategies, Mark.
I have to imagine there's probably a little bit of selection bias going on too. If they've made it all the way to the ORAT's back tester, they're probably a little bit more savvy. They're not just testing, here's my 2% out of the money covered call, right? Of course, you get those, I'm sure, too.
Yeah. Chris considers those basic, but I mean, I think that an iron butterfly for most of us noobs is a pretty good strategy. And what they're doing a lot is we have one of the things that we could do is a trade adjustment. So if it moves against you, you could then either have a choice to roll that leg out or roll the untested leg up. And what we're seeing in our back testing is rolling the untested leg up is usually what is working the best in the back test, at least. So that makes the kind of basic strategies a lot more complex, is the kind of the expiration adjustments.
He is the director of risk after all of this, and all strategies are basic to him at the end of the day. Chris, I know you want to chime in really quick, then we'll get John in here as well.
No, yeah, I totally agree with Matt here. I think the actual option structures, I mean, they're not difficult. They are. I didn't mean that they were basic, but I think Matt said exactly what I guess I wanted him to say. It's the management of these strategies that makes them complex, and how do the moving parts, how do they come together, and how do they fall apart when market conditions aren't as expected.
Yeah, you can make anything complex. I like Matt's idea for the call spreads, covered call spreads. Maybe that might be a good back test, or even a topic for a future show, because that's a comment we get a lot. I like selling covered calls, but I don't want to give up all my upside. So maybe that's a fun back test. I'm giving you. You're gonna hate coming on, Matt. You keep getting homework every time you come on. That's what you get for bringing so much good data to the table. Speaking of data, John, you have a lot of data just anecdotally talking to a lot of firms out there. You're out there actually doing this day in, day out, talking to advisors, fielding their calls. What are they calling you for? What are the strategies that they most want? Is it those top three that I broke down, or is there maybe something more esoteric in there that I left out?
Well, I could tell you between the three of you, I don't know that I have really much to add, because we covered both ends of the spectrum. I mean, the beautiful thing about where I sit within Northern Trust is really who I service, and it's anything from public funds, hedge funds, foundations, endowments, family offices, and corporations, and so all of the option solutions that those investors would be trading does kind of fall in those three buckets, as Chris eloquently mentioned, is your hedging bucket, your income bucket, and then kind of alpha or smart beta type trading. And so, and I certainly agree with the overarching objective is they have a purpose to do those trades, whether that be income generation on a portfolio, or opportunistic collars around a concentrated position, or then just putting on tail type of hedges, and then you have obviously then your investment manager systematic type investing that you would do kind of on the broad indices. And so I certainly think we covered it well for Mr. Bodine.
Yes, he can't argue that he didn't get his due here on the show. All right, next up, Tron S6, Tron 6. Pronounce it however you want. Tron 6. Let's go with that. This has kind of been a theme on the network of late. People have been writing a lot of account size questions. He's got a similar one for us here. He says, "What's your suggested minimum account size before I consider putting a client into options. So we've had this a lot of different ways. A lot of times people just want to know what their account size should be. This time, getting into clients. Let's go. I've had a chance to weigh in this a lot, so I'll let you guys dive in. We'll go back around the horn the opposite way. We'll start with John this time. John, if there's an advisor out there, maybe he's got a lot of SMAs and he wants to consider putting them into into options. In general, what do you think is a good entry point for him? Obviously, it's going to vary, obviously, depending on what he does, which of those strategies we just talked about he wants to employ, how capital intensive they are, that sort of thing. But in general, maybe if you have a rule of thumb, if you're talking to someone out there, an advisor, where's your bar? Maybe we'll start there. Where do you think is your bar? Don't go below this account level, this account capital threshold to really start using options effectively.
Sure. Yeah. If I'm, what you see as our RIA subset of clients that I would say kind of mini prime at Northern Trust, the most common account size that we would see within an SMA environment on the low end would be kind of that $10 million threshold. And the reason for that is because it tends to be when an RIA gets involved at the broad-based level. You're talking about doing index or broad-based ETF option trading that tends to be your more larger mandates. And so, again, some of the smaller ones that we have don't really fall below that $10 million base.
Matt, same question for you, sir. People are obviously coming to you, back testing all sorts of things. You're also active, talking to a lot of the advisors out there. What are you hearing, and what do you in general? What's your maybe that's a good way to categorize this question. What is kind of your minimum threshold where you think it's really viable to start using options on behalf of your clients?
Well, I think for $10 million, Mark, you'd be the only one that could go over to John's shop. So,
that's small potatoes, sir. You kidding me?
Yeah. So, I've listened to your other podcasts, and the stance I take is that if someone's interested in trading options, you could get in for a very small, even the smallest amount. You could sell a $1 wide call spread or a $1 wide put spread for very little margin and learn how the game works. And those aren't bad strategies sometimes. I actually, I do it in my own account if I don't have a lot of room left. So, I would say as small as humanly possible, if the person shows interest. The way I learn things is to jump in and do them. And the Cirilli study about registered investment advisors said that too. If a registered investment advisor trades options in their own account, they're much more likely to trade in their client's account. And I think the logic holds true even with their clients. You get them trading, get them learning about how the options move, and it's a learning experience. So I would be on the very low end, the smallest possible, just to do a $1 wide call spread or put spread, Mark.
All right, let's keep cranking, see if we can get a few more on here on the show. Matt Simpson, that's an interesting question. He wants to know, are there any of the larger advisory firms that you feel have a better understanding of options than others? I want more than someone who can just do 60-30-10. That's what we were just talking about earlier about the standard diversification breakdown, 60-40, 60-30-10. He goes on to write, maybe a nice covered call or collar, plus a few speculative plays like verticals. Let's go around. I guess we'll start with John, because John, you represent one of these firms. And I think just by the de facto fact that you're on the show talking about options means you guys at Northern Trust are in a different category when it comes to this stuff. So maybe what I'm saying is, go ahead, give yourself a free plug here for Mr. Simpson and what you guys are doing over there at Northern Trust. Can you guys handle, in his words, a nice covered call or collar plus a few verticals? Is that too much for you, John? Yeah.
Is it appropriate if I just say my phone number on the show?
You could. I think we already put your email out there. Give him your email again. How about that? And he could hit you up.
No, but in seriousness, I think it's important that just your listeners understand that it is important to work with professionals out there that do kind of have an understanding of the marketplace and what strategies are out there and that would be appropriate for the investor. I mean, whether or not you're an individual, an RIA, or an investment manager, or even a hedge fund. I mean, we work with some of the most sophisticated investment managers out there, hedge funds, RIAs, and 40 Acts, and then the ultimate asset owners as well. And so, to the extent that your listeners are looking for more of that hand-holding those resources are out there for them to take advantage of, and we'd certainly like to be a part of that.
That's the entire reason that this show exists, Mr. Simpson out here, is to help people like you learn more about the space, learn more to do for your clients, and also where to go to find more information or indeed to find a firm you want to work with. So if you want John's contact info, we said it at the top of the show. We'll get it again here at the end of the show so you guys can reach out over there as well. All right. Some of these are pretty lengthy. Let's see here. Here's a quick one for you, Matt. This goes right up to kind of your alley, where we were talking about earlier at the top of the show about earnings season and your data you have. He says, after all your data and research, are you still hesitant to recommend any particular strategy for trading options during earnings season? And Matt, this is something you and I have talked about a lot. You know, all the data kind of boils down to mostly a crapshoot, maybe slightly biased one way or the other, 52%, 48%, when it comes to even basic things like being long premium or being short premium going into an earnings event, which is why most people counsel to avoid that turbulence if you can avoid it. But that said, Matt, you're the keeper of the data, so I won't put words in your mouth. Do you have any thoughts here for misfits? Do you have a suggestion, or is it still pretty much a crapshoot in your eyes?
Well, with all the data that we have, it takes the crapshoot out of it. But my suggestions are usually that since these are binary events, you have to do and have the capital to do quite a few of them in order to get the odds on your side. So, and then it's also so if you're going to do a risky strategy around earnings, you have to do it very small. So if that loss happens, it's not going to affect your entire portfolio very negatively. So that's why I generally encourage risk less or not as much risk, having a vertical or a 1x2 or see what the options are giving up. We put out a lot of data out there, and that can then instruct what kind of an option position you want to put around it. That being said, a lot of people concentrate solely on, having a position before the earnings announcement. But I think it's a lot of people are missing some profit opportunities after earnings. So one of the things that we put out there is the expected implied volatility after earnings. So we have this way of looking at the skew and settling it after the earnings expectation comes out of it. And there's often some wide variation. So the market makers aren't getting the implied volatility to the level that they expected beforehand, and that often presents some opportunities. So there are opportunities, after earnings, especially if they crush the volatility. You could buy a straddle for a very low price, and our clients have had some success with that. So, risk off strategies. You could still participate on some of these on some of the signals that the earnings research is putting out. And also look towards, doing something after earnings. They might have a longer days to expiration and might not be as volatile, but there are some opportunities there, Mark.
That's one of the things I like about the data you guys crunch. I mean, obviously you do a lot of the historical analysis, which is obviously valuable, but also I that's one of the things I always key in on is kind of the expected after earnings crush, and also the actual earnings crush once you do the move results reports, what actually happens out there. Because you're right, that vol change after the event is significant, and it's something people should be aware of, and that there's opportunities therein as well, not just, as I often say, not just riding the barrel over the falls of the event itself, but afterwards. There's opportunities there as well. There's opportunities leading up to it and opportunities afterwards. You don't have to always just go over the cliff every time. There's other ways to do it. All right, speaking of going over the cliff, we're going long here. But you guys got so many questions. I want to make sure we get to some. So let's wrap it up on this one. This is a pretty meaty one here and a fun one also as well. So everyone will have a chance to chime in on this one. This comes from Douglas Tilley. And he says, hello. Well, hello, Douglas. He goes on to write, he's got a many-part question. Regarding long stock substitution, he has 3 questions. First off, with call options, are the deltas additive? So, for example, why are 2 40 delta calls so much cheaper than 1 80 delta call? This seems like buying the equivalent total delta for about half the cost. His second question is, for more accurate stock substitution, do you ever use the technique of buying an at-the-money call while selling an at-the-money put? So he says, versus buying the calls for a desired total delta instead. And then the third question is kind of related. He says, what are the pros and cons or nuances of the two methods? I do notice that the second method definitely requires more buying power due to the short put. Thanks for all the education. All right, this is an interesting one, a lot to get to. He's already kind of pointed out one of the nuances himself. Of course, the second question has to do with synthetics, actually putting on a synthetic long stock position, which is effectively a 100 delta versus something in the lower delta range of doing. But there's a lot to break down here. John, we'll start with you. Also, if you have a comment on the last question, you can feel free to chime in as well. But in general, what are your thoughts here from Mr. Tilley, who has a lot of questions about stock substitution and how it works?
Sure. Yeah, I did want to make a comment just on the heels of what Matt was saying, because I think it's actually really important. I could do more value on that versus Doug's question, but to be very honest with you. But the reason why I want to make this comment really quick is that just one quick little story. I was talking to an institutional client ahead of Tesla's earnings. This investor is currently long Tesla, the ones that just passed this past quarter, and the investor, as everyone kind of knows, it was more of a risk-off standpoint with Tesla, and the investor was like, is there something that we could be doing ahead of earnings, just because the implied volatility was so outsized according to just conventional wisdom, and it ended up that the solutions that we were considering, which tended to be short puts or short put spreads, et cetera, didn't prove out to be useful to do something pre-earnings announcement. But however, once the announcements and the guidances came out for Tesla, it created substantial opportunity for this client to enhance his position after the fact. And so I think Matt really made a very eloquent point as far as that it's important to look at pre and post earnings data when you're looking to make investment decisions.
So that's interesting to me, because I would have thought that the vast majority of your trades, and maybe they are the broad index of. I wouldn't have thought that you had a lot of clients looking to play, and so shall we say, more speculative, more volatile stocks like Tesla. But it sounds like you're getting some calls for those over there in Northern Trust as well, Joe.
Indeed, that's right. We to give you a sense of our volumes per product, index and ETFs is certainly our bread and butter, but which make up about 70% of our flows. The other 30% would be centered around single stock trading, particularly the S&P 5, but outside of that, within the consumer discretionary space as well.
Interesting, and it sounds like your clients could benefit from some of Matt's earnings analysis. So maybe you do have to share some data after the old show here. But lest we forget our friend Mr. Tilley here, Chris, why don't you have at it for our friend and his three questions? He wants to know about adding up deltas when putting on multiple options, and then also the value or the nuances of using a synthetic versus the underlying itself, and some of the things you should be considering there, sir. So a weighty question. Have at it, sir.
Sure. So if you're trading 40 delta calls, you're trading out of the money calls. So those have nothing but volatility or time value. In other words, they're just made up of a bunch of fluff, right? At expiration, what are they going to be worth? They're going to be worth zero because they're out of the money. If you're dealing with an 80 delta call, well, now you have some intrinsic value, and that has some meat. So that's kind of basically why you've got some pricing discrepancies. So if your objective is just to replicate stock and all you're concerned about is delta, meaning directional bias, you just want stock, right? Stock doesn't have volatility, it doesn't have theta, it doesn't have gamma, it doesn't have all these other risks that we have to deal with when we're trading options. Well, then doing we used to call them combos, right? That's the synthetic stock. You buy call and you sell put on the same strike. That's going to give you equivalent stock exposure. But you're right, it's going to be a little bit more capital intensive because you have a short put. Another thing that I've also seen a lot is, in kind of thinking outside of the box as far as replicating synthetics, is people that want stock replacement. They're selling out stock, but they still want some upside exposure, and they just replace that with call spreads. So that's a little bit different than, if you're trying to just replicate stock, I certainly wouldn't recommend buying 240 delta calls, because you're dealing with a lot of other things, other factors that if the stock moves up, your 40 delta calls may not make any money, and they're going to be asking why did they not make any money? Well, vol went down and theta and all this other kind of stuff. So if it's just stock, I would really just stick to the combo. In other words, synthetic stock buying call and selling put.
Unfortunately, that music means we've come to the end of another epic journey through the world of the advisor's option. Fascinating stuff. We have so many more questions we could get to. Maybe we'll do another all questions episode, because these questions, some of these are epic. They're whole page treatises on how you should be using options for your clients, or some nuances therein of the options. That's why we love you guys. You guys really hit us out of left field sometimes, which is part of the fun. You keep us on our toes, which is great. So keep those questions coming. We'll get to a whole bunch more, I promise, on our next upcoming shows here. But before we do that, before we wrap up, let's go back around the horn. Let's see what everybody is working on. I guess, John, we'll start with you as our newest addition to the panel. And also because I know you wanted to give out some of your contact info again here for people like I think it was Mr. Simpson over there, who wanted to learn more about what you guys are doing. And also in general, what can maybe any teases you want to give us for what we can expect coming down the pike from the Northern Trust options desk? Now is the time, sir. The floor is yours.
Thank you. Yep. So, we continue to be growing our presence in the options space. We have substantial growth that we've seen over the last year, both in with record volumes that we're trading across index, ETF, and single stock options. What's been great is that the biggest base that we've seen using these solutions is their institutional asset owner base. Your foundations and endowments looking to go working with third-party managers such as Swan in looking to have SMA mandates where you're putting in hedged equity strategies across multi-assets, and Northern Trust plays a really nice role in that, servicing the prime brokerage and execution capabilities for that space. And so it's been great to kind of be here and kind of leading the charge as far as our option business is concerned, and looking forward to many more years to come.
And if folks want to reach out to you directly, I know we said it at the top of the show, but really quickly, how can they reach out to you again?
John_Cherry at ntrs.com.
There you go. John_Cherry, spelled like the fruit, I might add, at ntrs.com. Mr. Matt, same question for you. You guys are obviously in the midst of your busy season right now with earnings. Even if there wasn't a lot of volatility on the docket, you'd still be in the busy season. So it's kind of like double busy season. But that said, what's coming down the pike from you guys and the team over at ORAT, sir?
Well, this has been great. It's great having John on. I look forward to this every month. So great job on the podcast. I was looking, and someone put their favorite financial podcasts, and the advisor's option showed up. So more kudos to you, Mr. Mark. As far as what we're up to, we're excited about our new data API. Like I said, we're looking at serial contango, how it goes back and how it looked at all the kind of market corrections, and we're getting a very good look at these volatility technical indicators, and we're using those in our back tests now. Our clients are really liking that. And we also have a backtest API, so you can you don't even have to key whack things in. You can have your programmers run thousands of backtests and show you the results. So we're doing a lot of that. I'm looking forward to going to Puerto Rico and visiting Chris down there. And that's about all we got going, Mark.
There you go. Check them out. ORATS.com is the place to find out more. That's ORATS. Give them a follow on Twitter as well, at OptionRats. Easy handle to remember. It sticks out in the mind, definitely. And of course, you can always find their earnings move and earnings move results reports on our website, theoptionsinsider.com. And last but certainly not least, Mr. Chris, sir, you guys are always cranking out new informative content on the website. You have your seminars. What's coming down the pike from you guys in Swan these days, sir?
Yeah, just real quick, we have got one new white paper out, which I co-wrote with Mark Odo. It's titled Know What You Own, Understanding the Diversity of Option Strategies, and that talks a little bit about synthetics and then dives into the different types of strategies that you can find in Morningstar's options-based category.
You're right. There's certainly, you could spend days learning more nuance than there is in the Morningstar options-based category. Let's just put it that way. But check it out. Swan Global Investments is the place to find all of that stuff. I recommend their blog. They have a lot of great data. If you want to check out more data on the study we even talked about today that Mark put together. The study is entitled, Will Bonds Protect in the Next Bear Market? You can find it all over there at swanglobalinvestments.com. I plugged them earlier. You couldn't make it on the show today, but head on over to optionseducation.org as well. Check out what Eric and his team are doing over there, the OIC advisor team. A lot of great stuff. If you love data and studies, that's the place to go for some data to arm yourself with when you're sitting down with clients and explaining to them why they should use these wonderful things called options. And on behalf of myself and John and Matt and Chris, and even Eric who's floating around out there somewhere, I want to thank all of you for downloading, streaming, subscribing, for listening live, and of course for sending in such great questions. Keep them coming. We'll get to more next time, I promised you. And we'll see you next time for more of The Advisor's Option.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. The Advisor's Option is also brought to you by Northern Trust Capital Markets, offering a unique blend of transparent trading, quality execution, and smart liquidity solutions across institutional brokerage, transition management, securities lending, and foreign exchange. Northern Trust's options offering includes quiet access to non-traditional pockets of liquidity, with hands-on support from experienced traders to customize your trading strategy, combined with the peace of mind that comes with trading through a stable and globally respected firm. To learn more, contact John Cherry at John_Cherry, spelled like the fruit, at ntrs.com. or visit northerntrust.com/capital markets.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.